Thank you so much for everybody for attending today. We really appreciate you coming. Enjoying this beautiful weather and that kind of stuff. We were just talking about how nice it is, and so we should enjoy this while we have it. We're always excited to do these. Once a year, we try and take and flip the topics back to things that cover taxation, financial issues, investments, some of the different divisions and stuff that we work in. And we really call this kind of our to-do list this time of the year, right prior to the time that people are really doing their planning and really thinking about how do we budget and what do we need to be doing. So in front of you, you have a full set of handouts of the presentation. If you'd like to have what we do today in electronic format, just let us know. We'll be glad to fire that back off to you and make sure you get it. We also have a CPE evaluation form, and we need you to turn that in if you'd like to have the CPE credit. We'd be glad to track that and do that for you. And then we also have an evaluation form if you'll let us know your thoughts on topics, what we're doing today and that kind of stuff. Also, just to remind you, all of these presentations are videotaped if the presenter will allow us to do that. We do run into some SEC, FINRA type issues, those regulatory type things periodically where somebody's compliance department says no, but most of them are in a vault sitting on our website. So if you want to talk to somebody or you want a piece of something to use, again, let us know. We'd be glad to get those to you. This morning's panel consists of three of our gurus, okay? And what we have internally is people in different divisions that basically spend their time in specialties. So this morning we have Mark Levine, who's one of our tax managers, and then Ryan Sawyer, who's senior in our financial reporting group, and then Curtis Harris is a managing director in our wealth management group. And each of them are going to talk just a few minutes as we flip through slides about different areas and different topics that they feel like need to be covered. Talking about their backgrounds just a minute. Mark received his accounting degree and master's in accounting from the University of Miami. He was with Alvarez Marsal Tax in Miami for a number of years, and in 2016 joined us. He has more than 10 years of federal and state and local SALT experience and has been involved in quite a few different tax issues over the years. Ryan Sawyer, who has been with us in the accounting group now since 2010, graduated from the University of Arkansas in Little Rock with a Bachelor of Science in Accounting. Started his original career in Little Rock area with a firm there, moved to Price Waterhouse here in Dallas, and then ultimately joined us in 2010. Ryan is also a CPA and a CFA, and also works over a lot in transactional stuff in the investment banking area. So he has the joy of moving back and forth and having to work with both the audit and financial side as well as Simon Martin and myself in the investment banking side. And then Curtis Harris. Curtis is an 18-plus-year-old veteran in the financial services industry. I've known Curtis so long, so I remember when he was in high school and college working in his mother's office, okay? And so we go way back. And really he was about 10 and I was 20 at that point, and his mother taught both of us a lot, right? But Curtis has been a veteran in that space for many years. He spends a lot of time working with individuals, family offices, working with family wealth, and helping people attain and set their goals. He's a well-known planner in Dallas. He's been featured in a lot of national and regional publications, including USA Today, the Dallas Morning News, Senior Advisor Magazine, and Fox News. In 2012, he was recognized as a 5-star wealth manager in Texas Monthly. He's also a speaker in a lot of different venues. He has a CFP license as well as a chartered financial consultant and a certified fund specialist. He has his BBA in finance and modern portfolio theory from Texas A&M. Didn't know that A&M did that kind of stuff. And then in addition, he received a certification in international business and finance at Texas A&M. So we're delighted to have everybody, and we're just going to jump in today. Feel free if you've got questions along the way, stick your hand up. We'll answer those. We'll also have a Q&A at the end. We're going to try and move back and forth between the topics and stuff some. Let's see. Which one? Which one, Ryan? Is it this one? Oh, the other one? Okay. So this was just another year of changes and stuff, and I'm going to let Mark start by just talking about taxes and the projection and some of the different things that have gone on in that space.
Yeah. So now that we're getting closer to the end of the year, this is a little bit earlier than last year's presentation, but still we should have already been starting to think about planning for the upcoming tax year. We still have time to make some, efforts to, increase our deductions in certain ways and stuff like that. Now, if you're here last year, a lot of these are going to look similar because while there were some changes, a lot of the stuff has stayed pretty much the same this year. With regard to the rates, the only real change is that, just every year they increase the brackets a little bit for, inflation and everything like that. So some people may, shift into a lower bracket if they're closer to the border. One of the big changes that they have made this year, they updated the depreciation regulations related to the new tangible property regs, and they increased the amount for non-AFS filers, audited financial statement filers, to $2,500 instead of $500. So what that means is that with regard to your expenses and your capital expenditures, you can actually deduct up to assets up to $2,500 rather than the $500 limit that they had before, which gives a little bit more opportunity to do some tax planning around that, to go through your expenses and determine whether or not there's opportunities to accelerate some deductions that you may be capitalizing into fixed assets currently. On the other hand, everything else for the most part has pretty much stayed relatively the same. So when you're planning and going forward, what you want to try and do is look at your tax situation, see what it is, especially in this year with we're going to talk about it a little bit later with the elections coming up. We don't know what's going to happen going forward because both parties right now have a very different approach to how they're approaching the tax regulations. So it's definitely good to look and see, what each one's doing and how best to determine what you want to do. Look at your opportunities for, accelerating deductions or deferring the income if we anticipate that the rates are going to go up. If the rates are going to go down, maybe you want to bring, do the opposite. So those are kind of things that you have to look at when you're going forward in planning. And especially one of the other things that they've done is they've made the 179 deduction permanent. They did that last year. We're going to talk about a little bit later the extenders and what was up in the air in the past this year actually may not necessarily be up in the air anymore. So with regard to 179, if you're looking at your company and your company is going to be in an income tax position, it may be beneficial to start looking at maybe we should go out and buy some capital expenditures, go buy some property, utilize the 100% deduction for 179. If you're going to be in a loss position, maybe taking advantage of the bonus depreciation, increasing your NOL for future purposes. Those are some of the things that you want to look at going into the planning, and you have to spend time looking at what your situation is, where your financials have you set, so that you can kind of look at what opportunities are out there. On the individual side, looking at whether or not you're going to anticipate some losses from some investments that you have, potentially selling off some assets that have some income, waiting the 30-day period, repurchasing them so that you recognize that income so you can offset the losses. These are all different things and planning ways that you can go about, minimizing your taxes. In some situations, you want to look at it and say, and see whether or not if the rates are going to go up in the next year, then you want to actually bring income into this year. And so maybe it is, if I look and I say the rates, I'm going to end up in a higher bracket next year, then I should sell off some of those assets that have gains, recognize the income this year, recognize the taxes this year, because I'll save it on the end in the following year. Some other things, charitable contributions, a lot of this was discussed, I think, in last year's presentation as well. It all is kind of the same. If you're planning on giving off stock to charity, it's better to give it as a stock donation rather than giving it as selling it and then giving the cash. the normal things. One of the big things that's going on coming up in the new year, which is on the next slide, is the tax return due dates have changed. And this is going to impact a lot of people. Now, in your slides that you have in front of you, it currently does show that the corporations, the 1120s, as being October 15th. That's only if you're a corporation that has a non-calendar year or a non-June 30th filing. They are going to be pushing towards a October 15th come, I believe it's starting tax years 2026. But for now, it is still currently September 15th extended due date. But the actual due date for extensions is now April 15th for corporations. And I think one of the reasons why they decided to do that was all the issues that they've been having surrounding companies receiving their K-1s on time and be able to file timely. So what they've done is they've pushed up partnership returns to March 15th and moved the corporation dates to the April 15th deadline. Another one of the things, if you have any foreign assets, the foreign reporting requirements have been moved from the June 30th, which was a hard deadline. There was no extensions in the past. They've now moved those to April 15th as well and allowed for the 5-month extension, 6-month extension to October. So that gives people a little bit more time with regard to those foreign reporting requirements to be able to get those done. If you deal with any exempt organizations, they no longer have the 2 extensions. They just give you the 1 extension to November now. And so those are some big things to kind of consider when you're moving into next year, and knowing that if you have partnerships, the extension is due actually sooner than it was last year, and that your corporations, you have a little bit of extra time to get that extension prepared, and if you have any payments due, to make those payments. Yes?
Do S corporations follow the partnership rules of the C corp?
The S corps stayed the same. The S corps did not change, and it's the same. If you look at it, an S corp is very similar to a partnership, so it was the same concept. They want to make sure that the K-1s get delivered on time. I think there was a lot of people, and we dealt with it in our office. We were getting K-1s the day of the deadline, and it makes it almost impossible to get things done and get things done properly. So what they've done is they've done this shift, I think, because they've had a lot of complaints with regards to that. So.
Texas R&D.
And I left the Texas R&D in here from last year just to kind of put it out there and keep it on everybody's mind that you have the ability to take an R&D exemption in Texas. But nothing's really changed with regard to that. I just wanted to make sure we left it in there to keep it in your minds to think about it as you're going forward.
And same with the franchise tax credit.
Yeah.
Yeah. Curtis, you want to talk about insurance a little bit?
Yeah, I think now's a good time of year to review all of your insurance policies. No one ever enjoys looking at that type of information, but you've got to do it at some point. I think this year's been an unusual year. I think a key point would be reviewing beneficiary designations, and I'm going to give an example. It's happened twice this year. Is don't make assumptions about how that your beneficiary designation, just because you set it one way 5 years ago, that it's remained to be the same, especially if you're talking about an employer plan. And one of the examples that's happened this year is I had a situation where someone had named their spouse as beneficiary, and then they got divorced, and they presumed that because they had children, they wanted to continue to have that ex-spouse be the beneficiary. Well, the state of Texas takes the interpretation that if you don't reaffirm that designation and say that you want my now ex-spouse to be the beneficiary, the state of Texas in this case interpreted they wanted the new spouse. He actually passed away. They wanted the new spouse to get the money. When in reality, I know for certain that he wanted his ex-spouse because he wanted his ex-spouse to take care of his children. So it created frankly a large legal problem. So again, it's important to reaffirm that stuff and don't take it for granted. Also on things like I said, retirement plans at work, I've seen situations where the beneficiary designation was set correctly, and then the plan changed from one provider to the other, and they just assumed that the beneficiary designation carried forward, and it didn't, and they didn't have a record of it, and it created a problem. Also, I think it's always good to review auto and homeowners policies. People sometimes get inertia on that. and they just assume that, oh, well, everybody's the same, and they're not. I mean, you can see wide differentials in pricing among carriers. Even if you're looking at, top-rated carriers versus each other, I mean, you can see 20 to 30% price differentials in a given year. So it is worth shopping in each year, and now's as good a time to do it as any. And also, if you've had any material changes in your business, I think it's worthwhile to reevaluate, is that the appropriate amount? Again, people don't love reviewing insurance, but it is something that needs to be done.
One other thing that we've noticed with clients that's really helpful, we've had an aging, number of business owners and stuff is putting together something we call a survivor book. And what this is just a book that has a table of contents, but it has a copy of bank statements, has a copy of, who do you contact about insurance, who do you contact about investments, that kind of stuff. So that especially if you're the last spouse, or if you're an aunt or someone who doesn't have children and someone's trying to pick up behind you, it gives you basically a step-by-step process to go through to find those details and to know where those accounts are. Where's the key to the safe deposit box, and what's in it, things like that people don't think about having all that in one space. And it just saves the hours and hours and issues of people trying to find their way through that process when someone passes away or is deceased. Health insurance?
Health insurance. I think I've seen a real underutilization of health savings accounts. I think that's partially due to, just the changing environment of the health insurance world. It went from, where you, especially if you're employed, you just handed, the doctor the card and it was taken care of. Well, there's been a clear shift to the health savings account world where really, in many plans, the bulk of your health costs need to run through your health savings account. And the underutilization I see is that whether you're buying, prescription drugs, or, routine medical things, oftentimes I see people where they're, at the end of the year, they haven't used their health savings account at all. And I talked to them and I said, didn't you have any sort of medical stuff? And they said, well, I had some small stuff, but, I just didn't bother with it. Well, I think in doing that, you're losing the advantages that the HSA plans, are trying to offer. And I mean, we do have a changing health insurance environment, and to a degree, we've got to change with it to take advantage of, the benefits that are there. Slightly different issue on the flexible spending accounts. You don't see these as often as you used to, but when they exist, you do need to use those funds by the end of the year, or you effectively lose them. In regard to reviewing Medicare coverage, right now is the time of year to do that. I think the biggest focus that I see is Medicare Part D, which is the prescription drug. I think a lot of people, that seems to be the most dynamic aspect of it, because most people, if they're on Medicare, typically sign up for Part A and Part B, and then they just kind of forget about it. And Part D can change quite a bit, and they lose sight of it. And then they ask me about it in January, and it's too late to make any sort of changes. So now's the time to focus on that for making any Medicare changes. As an aside to that, there are Medicare supplements if you are in Medicare. I will say that the Medicare supplement market changes a lot. You'll see a carrier like 1 year Blue Cross will have the best rates, and the next year you'll have a completely different carrier that will have dramatically different rates for identical plans. And Medicare supplement plans, if you're looking at, say, a Plan F to a Plan F, they're by law identical, but you will see wide price differentials. By wide, I've seen it where one carrier costs double to 3 times as another one. And you are allowed to change from one carrier to the other. There is technically underwriting, but it's not a situation where you're taking medical exams and things like that. Is that assuming you're not having crisis type medical issues, it's fairly easy to switch from one carrier to the other, and you can save substantial amounts of money. And then also, of course, schedule it. If you've met your deductible for the year, you should schedule costly medical procedures just to take advantage of that, because next year you might not meet the deductible.
One other comment that we have that we've run across in the Medicare and the drug area, and the reason supplemental coverage is so important, there actually are certain drugs related, for instance, to cancer, for instance, some of the nausea drugs and some of the actual cancer drugs and stuff themselves that are no longer covered by Medicare. And this comes up as a unbelievable surprise, and no surprise either. They're very expensive because they're not covered. And so it's something else to look at and to watch, especially if you've got aging parents, making sure they've got coverage and that somebody's thought about what happens if this happens to you and how do you cover that. Because it's suddenly, we've seen some of them as $1,000 for pop, for different types of drugs and stuff. So it gets really expensive quickly. Estate planning?
Estate planning. I think estate planning, in a good way, I think has stabilized in recent years. That may change going forward, but for now it's stable. In the sense that, for the vast majority of the people, that the bulk of estate planning is really just, do you have a will? Do you have a trust? It's not the estate tax burden, for the most part, has shifted away from most people because we've got relatively large lifetime exemptions of 5.45 million. That said, I wanted to kind of focus on one thing that Mark had alluded to, is that gifting highly appreciated assets when you're making charitable gifts. And I think this is something that is really underutilized, as people think of it as got to be, I'm making some monumental gift. Well, I think if you're going to write a check for $1,000 to your church or your favorite charity, I think it's far better to gift a somewhat appreciated mutual fund or stock, because it's very easy for those charities to handle that. And I would say I would almost never just write a check to a charity. Unless it was $50 or something. I would always gift a appreciated stock or mutual fund, because again, it's very easy for them to handle that. You can always pay medical and educational expenses directly to the institution. For grandchildren or children, and it doesn't apply to the lifetime gift exemption. I've seen situations where people didn't do that, where they wrote a check to the child and then they turned around and it created some problems. But again, paying it directly is preferable. Regarding post-election impact, it's hard to predict, because there's such extreme views, depending on who goes. On one side it says we're going to get rid of the estate tax entirely. And the other side, for the most part, it seems like they want to keep the status quo, but we'll see.
She wants to increase it to 44%, I believe, as well as drop the exemption from 5 million down to like the 3 million.
And I think that'll be unlikely that they'll be able to get that through. But anyway, that's a political discussion.
We all know there's a pot of cash or a pot of gold at the end of the rainbow there that I'm not sure that the government's going to be able to resist. And, we're continuing to hear numbers that just in the private business owners across the United States, that the next 10 or 15 years, we'll see $26 trillion of wealth transfer, that goes on. And the number keeps growing. And so we full well expect that you're going to see that you're going to see dollar signs in the people in Washington's eyes, especially as there's budget crunches and different things going on and trying to fund programs. I think it's something we need to understand. It very well might happen. It came close with Bush, and there was a massive rush with, when they thought that the exclusion was going to drop to $1 million or $2 million. I think we'll see that same thing again with people trying to do some gifting. Retirement.
Retirement accounts, I think there haven't been any substantial changes here. These are just kind of going through some of the key ages regarding when you can take distributions. If you are over the age of 50 or older and you're behind, or actually even if you're not behind, you can make additional contributions, catch-up contributions to 401k plans, which I would encourage you to take advantage of it if you haven't already. Other key ages are age 70 and a half. If you've reached age 70 and a half, you do need to start taking required minimum distributions. I've seen situations in the past year where people missed that, and the penalties for not taking those distributions are high. For the most part, the investment companies do a pretty good job of notifying you when those are going to occur, but I wouldn't count on them completely. And I would always double check them, because I've seen some situations where they've miscalculated for various reasons. So it's not something in particular, especially when it's your first required minimum distribution. I would double check the calculation rather than relying on the investment company. 529 plan contributions, these are similar to the gifting rules, though there is an exception where you can make 5 years worth of gifts in 1 year. Just it's basically an advance on those the next 5 years. These are intended for college savings. I think it's an exceptional benefit. There's not very many situations where you get tax-free growth from the government, and this is one of those. And with college costs escalating the way they have for the past 30 plus years, I think you need every benefit that you can get, because I keep predicting for 20 years I've been saying, well, college costs can't continue escalating this way. It's not sustainable, and I keep being wrong. And so who knows what the next 20 years is, but I mean, it's a problem. And then finally, there's been some changes in Social Security. They've eliminated some of the little loopholes that you could do, but I think it's always good to review Social Security. We have some software that if you want to see, we can model various scenarios of, especially with couples, to maximize Social Security benefits.
Go back to personal issues and changes.
Yeah, this area here is just kind of going through the different things you need to consider from a personal side when you're considering your taxes. Every year, these are the kind of the bullets of the things you need to look into or know about if it's happened during the year. Whether you've moved and bought a new house, selling major assets, transferring finances, ending a marriage, getting married. All of those things have impacts in how your taxes will be affected during the year. So it's always good to get in front of them, consult with your advisors on things that may have happened during the year, so that you have properly planned and know, so that when you go to extension time or when your tax returns due, something doesn't blow up in your face and end up owing a lot of taxes because you didn't realize that has an impact. So these are just a list of the variety of questions that you should be asking yourself every year, just to make sure you've got everything covered.
Let's go back to corporate planning and just wrapping up 2016.
Okay. The main thing I wanted to do here was sort of give some suggestions to think about as the year end approaches, ways that maybe you could improve the financial position of the company, or even the business and the future of it. The first thing that maybe you could do at year end is possibly call some of your customers and see if they want to make a large order, because you have to remember that on their side it's a tax deduction. Maybe they want to buy a huge piece of equipment and take advantage of some of the stuff that Mark suggested. And also, as far as the year end expenses go, the same kind of thing. Maybe you're expecting to buy a certain thing, but looking back at your budget, it didn't end up that way. So maybe you need to go ahead and do it. Call your vendors, see if you can get price concessions, or call other vendors, see if you can get their competitors to fight it out over you. And maybe you can, or there's a risk that your current vendor may run out of the thing that you need. Maybe you need some backup vendors just in case. So those are some of the things that you can look at as the year end approaches. And then from a rewards standpoint, this is the time to look at the bonuses at the year end, and also the contributions to the 401k plans. Review the compensation packages. Are you really incentivizing the people, incentivizing your employees the way that you wanted to? Are they doing the things that you were attempting to accomplish? Also, these days, people are more and more working from home. Is that something that your employees are wanting to do? It could save you a lot of office expenses, or wherever you have your place of business. You can alleviate all of that cost and just have them work from home, and maybe that would be a good productivity boost and cost reduction. And so you can look at studies of that. Also, as far as the year-end closing goes, you should probably have a checklist that lists out, these are all the things that I'm going to do to my accounting records to make sure that they're accurate. You've got to do an inventory count to make sure all of the inventory that you think is there is actually there. A lot of times it'll walk off. And do some variance analysis. See, is this a reasonable amount for my inventory to be missing? And look at the AR reserve. You can go down and look at all the customers that you have AR outstanding for. Maybe you need to call them and see what's the deal. Why have you not paid in 90 days? This is a big balance. Maybe you need to cut them off. And also collections. Maybe you can send a lot of your AR balances to collections and get a big influx of cash near year end that you need, that you weren't able to collect anyway. And as far as the financials go, you can check the new accounting pronouncements, make sure that things that you're recording things the way that they require. Make sure that all of your that you're able to reconcile all of your accounts, especially in our whenever we're preparing financial statements or auditing them. I mean, that's the first thing we're going to look at is there some kind of support, and does it agree to the trial balance? And accrue your expenses. Look at what you've actually expended this year, not necessarily from a cash basis, but what you are going to actually owe eventually. Do a fixed asset count. I think that's something that's unusual for, especially from a financial perspective account or financial statement perspective. Go out and see if that forklift is still there. Is this property burnt down? Also look at impairments. If you bought a company a while back, you'll maybe have some goodwill that you need to see. Is this company still profitable? Is it worth what we paid for it back then? And so then, as far as next slide is audit readiness. So. As far as audits go, we want them to go, whenever we're performing them, we want them to go as smoothly as our clients want them to go. And it's hard because there are a lot of moving pieces. But the first step, I think, for our clients is to understand the audit process. We're going to plan first, and then we're going to do the testing, and then we're going to issue reports regarding our findings. And, we like to discuss with our clients the expectations, develop a timeline, hold us to it, hold us accountable. When we request things, we like to keep up with the items that we've received or sent. That way we're both on the same page. So I think communication with us is the key, and especially in the planning process, we really want to understand the business and the different accounts, because that makes things more efficient. We can decide we can decide how to test a particular item, and if you see that we're doing it inefficiently or there's a better way to do it, let us know, because we definitely want to do it better and more efficient as well. And so when the testing comes about, have a dedicated person that's going to be the point of contact, or the one that's going to help us and is knowledgeable about the business, and have support accessible, have invoices that you could pull if we were to ask for them. And also at the end of it, we'll issue reports, and we make mistakes too. So our reports could not be the way that you expected, and let us know. Review them really well. So. And also a lot of accounting changes this year that could affect you. The first two, the leases and the revenue recognition, really don't come about until about 2018, and they've been negotiating them for a while. But you can early adopt them. The leases will possibly put a lot of leases that you've been just expensing every year to actually put them on your balance sheet. And you'll just offset it with an asset as if you're doing a capital lease. But in revenue recognition, it's kind of similar to the way it's been so far. It's just now the accounting rules are trying to integrate the U.S. standards with the international standards. And so just kind of some changes in semantics and such. The inventory is just a change in semantics. It goes from doing the lower of cost to market to lower than to cost of net realizable value. Kind of a similar concept, but just a change in semantics. And then the 401ks are becoming a hot topic, especially in the auditing side, because they're really cracking down on it, and rightfully so, because it's a huge fiduciary duty that you have to your employees. Should your employees really pay those expenses and costs? Is that too high? Maybe I need to look at other providers or plans that are more conducive to what I wanted for my employees' financial health. And so then corporate planning goals. Towards the end of the year, you can really look at what's happened so far this year. What were you expecting for the company? What can I do now to change the trajectory or change the next couple years? And you can do that through forecasting or budget analytics. Go down your trial balance on the income statement side and see, hey, why did we pay this much in rent? I thought we were going to pay this. Why are our employee costs so much? And also from the revenue side, look at what's driving it. Is it your product that's bad? Is your sales team not working hard? Are you not compensating them in a way or incentivizing them to where they want to make more sales for you? So you can consider all those things, and then profits. Look at your costs and make sure that it's conducive of a way that you wanted your company to be financially positioned. And marketing and advertising is becoming more and more digital. Do you have sort of an antiquated way of marketing your company? And different companies are different ways, but there are several firms out there that will help you to build your website and to have your Facebook page, help you track what type of person is it that buys your products, or what do they click on before they get to your website, and then what do they actually buy when they do it. And so you can maybe call one of them up and see what are your options. Technology and innovation. Is your product the way, or are you becoming the business of a typewriter? Do you need to maybe diversify into other things, or make your product more in line with what people are demanding today? And compare that to your competitors, to benchmarks, to the industry. What are they doing that works that you could maybe copy or improve? And so those are all kind of things you can do to possibly improve the trajectory of your business. And also from a risk management standpoint, Curtis has got the insurance front, but you can consider, are there risks that I don't need to insure? Maybe that risk is mitigated elsewhere. Maybe I can combine a lot of risks into one policy and make it cheaper, lower premium. Just kind of look at everything that you're trying to mitigate the risk of. And business interruptions are a big deal. You don't want to have you don't want to be paying people for doing nothing. And cybersecurity also these days is a hot topic. I guess it's sort of like locking your home. If someone really wants in, they're going to get in, but there are a lot of ways to mitigate that risk, and a lot of people who are good at it. And so review credit terms with your customers. Does this guy have $50,000 on your AR, and he's maxed out in your credit, the amount of credit he can get? Maybe you need to cut him off. And also supervision of employees and locations. Are they really, you'll do performance reviews and such. Are they really doing the things that you want them to do? Are you incentivizing them? What is the market, salary? Maybe you're getting a lower end of employee paying them less and such. But just kind of look at those factors. Look at your location, your different locations. Maybe there's one that's out in the desert, and you haven't been there in forever. You don't know what's going on there. Fly down there, see if Bubba's still coming to work. And so also your new entities and locations and services, are you integrating them the way that you expected to? Maybe that business that you bought this year turned out to be a bad idea. Maybe it doesn't mesh well with your employees. The culture of the other company doesn't mesh with yours, and maybe you need to consider changing things up there. Concentrations. Maybe you have one vendor who supplies this particular product, and that gives them a lot of power to charge you more than maybe the market rate. Maybe you can figure out different vendors who could supply the same thing. Customers, the same thing. If your customer goes bankrupt, what happens to your company? And so internal controls is a good time to look at the processes you have in place. Maybe Susie doesn't do that particular task anymore, and there's a risk that someone could steal money now. Just kind of look at the way your accounting processes go, and make sure they're all still tight. And employee performance we discussed briefly, but yeah, make sure they're doing what you want. Your managers are managing the way that you wanted them to. And okay, so lender discussion. This is an opportunity to modify your existing financing if you'd like to do that. Change up interest rates, change up the covenants. Call your lender, see what his thoughts are. And this can go in line with your forecast and budgeting as well. If next year you need to buy 10 vehicles, go ahead and start talking with your lender now. The most expensive capital that you can get is the capital that you really need. And so if you go ahead and it's a very lengthy process for them to go through the underwriting. So go ahead and start now and planning for that, those different purchases that you need to make. And so that kind of wraps up with an overall look at your company as a whole.
Yeah, and I think that what we see is a lot of our clients just struggle with change. The change is coming so rapidly, and there's so many things to consider. That's the reason we keep encouraging clients, take this list, highlight some things you need to look at, but we just keep seeing clients struggling with, is the market moving away from them? Are there people incentivized? I sat in a board meeting this week where the company can't even agree now on what size projects, and what it is people go, and we've all heard this, well, we've always done it this way, and we've always followed these kinds of rules. Well, those rules aren't applicable anymore. It's kind of like the typewriter. It's just not there, and they're struggling with getting people to make those changes. The other thing we see with clients is trying to figure out, they don't have their numbers current enough, and so they can't sit down and take a look at tax, financial reporting, and bank covenants, all three simultaneously. And because one of the things we're really sensitive to with a lot of our middle market clients is if we're over here and marking them and doing tax planning, what impact does that have on the financials and the ultimate covenants? Are we going to bust a covenant because of that? Or we've had clients that because they weren't thinking ahead about what equipment they needed, and they needed those 10 new vehicles, next thing we knew, they'd blown a covenant when all of a sudden they went out and borrowed from some other entity that nobody knew about, and next thing you know, the covenants had a bust. I mean, there are all kinds of changes that people have got to watch. One other thing we mentioned back there is the cybersecurity. I would suggest everybody look at some form of a policy for that in terms of just what happens if. I mean, you've seen some of the slides that we put up over the last year or so about the number of potential hacks and what's going on and how your systems are being bombarded. If that ever happens and your client data, social security numbers, PIN numbers, all that stuff gets out in the market somewhere, or even just the ransomware. We had a major insurance company client this year that got hit with ransomware. They locked it down, they paid those people twice, and they still never got their data back. And they ended up finally just having to rebuild everything and found themselves almost 6 to 9 months behind. They didn't have appropriate backups in their system. It all just came tumbling down. And you don't think about this. You think, okay, banks, insurance companies, all these people, have it together, and we all just kind of take for granted what's going on when that's not the case. And that's the reason some of this stuff sometimes kind of seems elementary, but when you start thinking about the what ifs, that's where we tell clients that's the stuff that we hope doesn't jump up and grab you.
Just a quick question, Greg, on that, because I was at a conference by Chase for Business 2016. They had a work session on cybersecurity, but they talked about you could buy insurance now for that. Could you elaborate on that if you know anything?
We actually bought it ourselves this year, and our head of IT brought it to us and said, look, and it covers things like the cost of dealing with the public relations issues, the cost of if clients start suing you or people start suing you over their data and information getting out in the market. It helps cover some of the restoration, just like business interruption coverage if you've got to have help in those areas. There's a whole litany of things down through there that you don't think about. It's almost like a waterfall. Once it starts running, it's kind of like water in your house. It just starts spreading, and you don't know how far the damage, and you can't control it. And it's having someone to stand alongside you and a team of people that the insurance company basically brings to the table. I think it's all that kind of important stuff. I memean, it still has deductibles, coverage for different areas, but it begins to get you thinking, and it's actually not that expensive. I was amazed. It was just I'm going to call it, Ryan, correct me, a few $1,000s. I mean, it wasn't. I'm going to say it was like $2,500 to $3,000 for millions of dollars of coverage. And so it's not something that's a huge number, but let me tell you, if you start having to fund that out of your own pocket, and you're behind, you're trying to keep your business running, it's things like that cause companies to get set back decades.
A small business in that market, small to mid-sized business got hacked, would be out of business within 6 months.
I agree.
It's devastating.
Yeah. And I think it's the same thing with people not planning and not sitting down and looking. And, that's why we keep saying, remember what the dates are, because we're going to have to do the planning in the fourth quarter with you with all these different areas. And then we've got to turn around and by those due dates Mark was showing you, be able to tell you what your estimated payment needs to be. And if you're not paying that on time, then you got penalties, interest. The problem starts escalating on you quickly. And profits are hard to get. I mean, I talk to clients everywhere, and it's like this year, it's been up and down and things moving around. I mean, with the oil and gas market, that ripple has finally worked its way through. There's just a variety of different things going on. I think the election has created some angst on people's part. Things have seemed to have slowed down. I move around between a lot of different board meetings, so I get to see and hear from a lot of companies. And a lot of people are just struggling to get a black bottom line. I mean, they're just excited if they end up with a few $100,000s of profit where that number used to be in the millions. And it's just also finding people. We constantly hear in this Dallas market, finding people, planning ahead for who you need, the recruiting fees that it costs to buy those people. It's going to be 25 or 30% of base salary. It's not going to get any better. We were talking about how people work, figuring out what you do when it's an hour to this building from Frisco to here, a lot of days is an hour and a half drive. What do you do with your people? How are you going to work with that? How does that fit in your budgeting and all the different things with technology and systems? That's the kind of stuff you got to be thinking about. And I would suggest, and we are going to do this ourselves, in early December, we're going to have pulled some of this stuff and sit down and really take our strategic plan and figure out what is it we need to be doing? What are the things we can do to make a better work-life balance, to keep our people? And how do we make that work better? How do we better service people? How do we plan? I mean, we have the same problems all of you have in a different kind of industry. And so I can't encourage people enough to look at that.
I just put in here, and I know we're running low on time, so I'll try to go through this a little quick, because in this year, normally we get to this time of year and the Congress extenders are usually up in the air. Congress hasn't made any decisions about anything. Well, last year they actually made a lot of extenders permanent, and a lot of the ones that people care about, the 179 deduction, some of the individual stuff like contributions directly from an IRA, all those were made permanent, so they're no longer an issue that you're worried about coming into the end of the year. And some of the other ones, like bonus depreciation, were extended out 5 years. So going into this year, the Congress extenders are actually kind of more known than they have been the last couple of years. Some of the ones that are still kind of up in the air, above the line education credit, a lot of individual stuff. The mortgage premium deduction still up in the air, but typically they usually extend those towards the end of the year or next year. One of the other things that I wanted to just kind of bring up is not really an extender, but it is something that they're continually kind of looking at, which is the tangible property regs. I brought it up before that they increased the non-audited financial statement requirements to 2,500, but they're still cleaning that up and still trying to get feedback and figure out what they're doing. So you may want to keep your eyes on that to see what's going on there. And yeah, the next thing we wanted to kind of cover with this being an election year is what the impact may be. Now, granted, we all know that Congress kind of twiddles their thumbs and never really can make a decision on things. So the candidates can say whatever they want, but at the end of the day, Congress has to agree and actually push it through. But what we've done here is kind of listed out both sides, what Clinton's proposing versus what Trump's proposing, and you can see there that there's significant differences. Clinton wants to put an extra bracket into the individual tax bracket, basically by adding a surcharge to high wealth individuals, where Trump wants to bring it down to 3. From a corporate perspective, Trump wants to bring down the corporate rate to 15%, whereas Clinton's kind of, indifferent to that right now. She has no proposal on the corporate side of things. But you can go through what's there and take a look so you can see it. But like we've been saying the whole time, it's a very up in the air thing. We know that even in election times, after election goes, they can say this, that, and the other thing. But with Congress the way it's been over the last few years, the likelihood of anything really getting pushed through in any particular time, it's really not. It's unlikely.
I don't want to wade too deeply into this, but we get a lot of questions from both sides. I will tell you that everyone's concerned about the market. Doesn't matter where you fall on the political spectrum. There aren't any hard and fast rules. I will say that markets have tended since the 80s to be positive, both in election years and subsequent years. Go to the next slide real quick. And so you can see the green bar is in the year after an election, and the blue bar is the year prior to election. Again, it tends to be positive, but if you look farther back in history, there are some noticeable negative years. I will say this as a caveat to that, before you lose all hope that there's we're just headed for some market crash, is that if I were to do an overlay of emerging markets, they have tended to where when the U.S. markets are down, they have gone the other direction historically. So my best advice would be to don't be so singularly focused on the U.S. stock market. Diversify using emerging markets and even developed non-U.S. markets, because that does provide the diversification that rides things out. We tend to just be so singularly focused on the U.S. markets that you're really missing out if you don't have emerging markets exposure. And then finally, this is just looking at returns. This is during presidential terms. You can see, with a handful of exceptions, whether it's Republican or Democrat, the long-term trend on the market is positive, and that's really the message: is stay invested. It's a long-term focus.
Questions?
Yes.
One curiosity. On your first page, you talk about under another year of change, it says at age 60, it says after age 65, or disability, delay payment of property taxes. What does that mean?
That's really kind of discussing kind of delaying it, whether you pay it in the current year or pay it the year after. Because when you pay property taxes, you can get the discounts of paying it up front or waiting to the subsequent year. So in the year of someone's, I believe they're talking about a delay until someone's death, if you pay the property taxes in the subsequent year, it reduces the estate, which is more beneficial with the higher rates. So that's kind of what we're getting at there.
We'll be sticking around. If you want to talk, you have other questions and stuff. Again, we're delighted to have you. I know we blew through a lot of information today, but it was really meant to give you a checklist of things to think about. if you have questions, you don't get them today or you go away, feel free to call any of us. We'll be glad to jump on the phone, do a conference call with you, come out, sit down and talk through some of these things. We have templates, things that we can give you to help you through this process. We do think it's really important. We moved it up this year to really give people a couple of months to get through this process. One other thing we didn't touch on today, we touched on the 401ks a minute. Pay special attention to that space. The DOL is hovering very, very closely in that space. And we're seeing it all the time where they're constantly looking at even some of the smaller plans. It's just a real hot button in the auditing profession and with the Department of Labor. So be prepared, make sure that everything is tucked with a bow around it in that space, because they may come knocking on your door doing an audit. And we've seen that regularly. It's not just the big boys anymore. Again, we thank you so much. Feel free to drop off your stuff outside. If you need parking, validated and stuff, we'll take care of that. Again, we're delighted. Please turn in your evaluation forms, and we'll see you again after the first of the year. We have a bunch of really great things. And talking to cybersecurity, I think that's our first one in February. Am I right, Ryan? And somebody just talking about that space. So we're going to start you off with something just scare the crap out of you starting in 2017. Have a great Christmas, and we'll have some Tums for you in February. Okay?